Hi, I am Eli Lee, and this is Bank of Singapore Research. US inflation and labour market data for the month of January was surprisingly strong, showing that the economy has not cooled enough to return inflation to the Federal Reserve's 2% target despite aggressive rate hikes so far. We now believe that the Fed will hike another 25 bips in June, on top of two more 25 bip increases in March and May, which will bring the Fed funds rate up to 5.5%. Although our base case remains that the US will fall into a mild recession in the second half of this year, we do not expect the central bank to cut rates as it will continue to focus on curbing inflation. This picture of sticky inflation and persistent Fed hawkishness is likely to challenge the strong start in developed market equities this year, especially as earnings expectations continue to weaken with corporate profits under threat. The strength of the Chinese economic recovery continues to be a bright spot. Activity is quickly normalizing after the end of zero-COVID policies. As Chinese authorities pivot towards pro-growth policies, leading indicators of the business cycle such as money supply and credit creation growth signal that a firm uptrend in the business cycle is unfolding. Given undemanding valuations, improving earnings prospects, and a positive policy backdrop, despite a near-term consolidation, we see more gains ahead for Asia ex-Japan equities, particularly for China and Hong Kong, and maintain our overweight position. In our asset allocation strategy, we maintain an overall defensive approach and expect markets to broadly experience a volatile bottoming process before staging a sustainable recovery. We are overall neutral in equities, with an overweight position in Asia ex-Japan offsetting an underweight position in Europe. In fixed income, we favor duration over credit, with overweight positions in US Treasuries and DMIG bonds, which are recession hedges. For more information, please refer to our monthly investment guide titled Focus on Resilience.